So if you think back to the 1980s, I mean, the world honestly thought Japan was going to just buy the entire planet.
Oh, yeah,
Like
absolutely.
real estate in Tokyo was supposedly worth more than all of California, right?
Yeah, the Imperial Palace grounds alone were valued higher than all of real estate in California. It was wild.
It's crazy. They were buying up uh, Hollywood studios, golf courses, all these iconic American skyscrapers.
Right?
But today, it's completely flipped. Japanese corporations are quietly draining their national wealth just to pay like their monthly cloud computing bills to American tech
Yeah,
giants.
it's a massive shift.
And it makes you wonder, right? How did an absolute export powerhouse become trapped in this perpetual digital deficit? So, welcome to our latest deep dive. Today, we're taking you on a journey to explore the macroeconomic destiny of Japan and its currency.
It really is a stunning reversal of fortune, honestly. And analyzing the mechanics of how it happened
Mm-hmm.
and, more importantly, what happens next is just a massive puzzle.
Totally. So, our mission for you today is to unpack this highly detailed research framework we received. We're pulling primarily from two really fascinating analytical texts.
Right. So we have investment prospects and the yen exchange rate.
Exactly. And the other one is analysis of Japanese investment and consumption decisions. And our goal here is to basically map out the huge structural forces that are actively reshaping Japan's wealth.
Right, because we are talking about, aging demographics, the shock of high energy prices, the global race for artificial general intelligence, and of course the massive weight of U.S. monetary policy.
Yeah, all of that. And we're going to use that framework from the sources to project a really specific timeline. Like, we want to evaluate the Japanese yen's potential movements over a 5, 10, and 15-year horizon.
Yeah, charting it against both the U.S. dollar and the Chinese yuan, which is super important right now.
Super important. Now, before we jump into the deep end here, I do want to give you a quick disclaimer.
Good idea.
The analytical documents we're exploring today, they outline some pretty highly charged geopolitical concepts. I mean, they explicitly describe mechanisms of foreign nations extracting wealth from Japan.
They don't pull any punches in the text.
They really don't. So to be completely clear up front, our role in this deep dive is just to impartially report and synthesize the analysis contained in this source material. We aren't taking sides. We're not endorsing any specific political viewpoint.
Exactly. We are simply breaking down the framework that these authors have built.
Right. So to map out that 5, 10, and 15-year future for the currency, we sort of have to establish the baseline of where the Japanese economy actually sits today.
You have to. You literally cannot chart their future without understanding the um, psychological and financial ghost that kind of haunts their domestic market.
The ghost, right, because the documents bring up this concept of the balance sheet recession. They point to it constantly as the root cause of basically all their current behavior.
Yeah, it's everywhere in the analysis.
So break down the mechanics of that for us because, it sounds like standard economic jargon, but the text treats it like this deep generational trauma.
Well, I mean, it is a trauma. So a balance sheet recession happens when a nationwide asset bubble just bursts.
Okay.
And for Japan, this was the early 1990s real estate and stock market crash. Just overnight, the value of the properties and stocks that companies and individuals owned plummeted.
Right, the bubble popped.
Exactly. But the massive loans they took out to buy those assets, those stayed exactly the same.
Oh, wow. So the debt doesn't shrink, just the asset value.
Right. So an entire nation's private sector looks at its balance sheet and panics.
Yeah.
They shift completely from trying to maximize profit to just minimizing debt.
They just go into survival mode.
Exactly. They stop borrowing, they stop investing, and they just funnel every spare yen they have into paying down old loans. And the kicker is, they keep doing this for years.
Even when things get better.
Even when the central bank slashes interest rates to zero. Like free money, and they still won't take it.
Man. So I look at it this way. Imagine like a local business that makes a terrible bet and racks up massive, really high interest credit card debt.
Right. Okay.
And for the next 20 years, instead of taking out a cheap new business loan to buy better equipment, hire top talent and grow, the owner stubbornly pours every dime of profit into paying off that old mistake.
Yeah, that's exactly it.
Like, the business might technically survive, but its forward momentum is completely stalled out.
That captures the dynamic perfectly.
Yeah.
Like, a whole generation of corporate managers in Japan became hardwired for this intense caution.
Yeah.
Even today, major Japanese corporations, they sit on massive piles of cash because they remember the sting of that crisis.
They're just terrified to spend it.
Exactly. They won't aggressively invest domestically,
Right.
and that historical cycle fundamentally suppresses domestic demand, which, drags on the currency.
But the historical hangover is colliding with a much more physical problem now, right? The demographic trap.
Oh, yeah, the aging crisis. It's severe.
The labor shortage is just wild. And the documents detail how Japan is betting on a few almost futuristic trends to survive this.
Right, specifically widespread automation. They want to replace human workers with tech.
Right, and also this development of what they call super city clusters.
Yeah, those super city clusters are fascinating. The concept there is to build these hyper-dense, hyper-efficient urban zones,
Yeah, but to do what exactly?
to consolidate healthcare, logistics,
Yeah.
and resources for this rapidly aging population, basically shrinking the physical footprint of society to make it manageable.
That's incredible. But I want to connect the dots here for the listener because the documents argue that this lack of workers actively dictates the long-term devaluation of the yen.
Yeah, they do draw a direct line there.
So how does a shrinking population physically force a currency's value down?
Well, think about the mechanics of supply and demand on a national scale. If your workforce shrinks, your domestic market shrinks.
Right, fewer people buying stuff.
Exactly. So companies cannot grow by selling only to Japanese consumers. To survive, they have to look outward. They offshore their production.
Ah, okay.
And simultaneously, the country heavily relies on importing goods. They no longer have the manpower to make it home.
Right, they just don't have the hands to build it.
Exactly. So when a country is constantly importing more than it exports, it must constantly sell its own currency to buy foreign goods.
To get the foreign currency to buy the import.
Exactly. That relentless selling pressure structurally caps the value of the yen.
Wow, okay. Which brings us to the current fiscal reality holding the yen down.
Right.
Because the research points to this political and fiscal push, they term Sinonomics, right? Or Takaichinomics, named after the conservative politician Sana Takaichi.
Yes, exactly.
And it's basically this aggressive push for government deficit spending tied to national security and growth. But doing that requires massive borrowing.
Massive borrowing. And that creates a huge trap for the Bank of Japan. I mean, the national debt is astronomically high right now.
Oh, wow.
It's over 250% of their GDP.
Wait, 250%. I need to stop you there. Because I'm looking at what the U.S. Federal Reserve did recently.
Right, with the rate hikes.
Yeah, they just aggressively raised interest rates to fight inflation and defend the dollar. Why can't the Bank of Japan just do the exact same thing to save the yen? What is physically stopping them from flipping that switch?
The math of their own debt is stopping them.
What do you mean?
When you have government debt that is 250% of your entire economic output, the interest payments are a massive line item in the national budget.
Oh, I see where this is going.
Right. So if the Bank of Japan raises interest rates to, say, 4 or 5% like the Fed did, the cost of servicing that astronomical debt just explodes.
Because suddenly they owe 5% on 250% of their GDP.
Exactly. It would literally consume the government's revenues. It risks bankrupting the state.
Wow.
So they are paralyzed. They are completely trapped, keeping rates near zero, which basically leaves the yen defenseless.
So if the central bank is paralyzed by debt and the labor force is shrinking, how on earth does Japan defend against external global shocks?
That's the million-dollar question.
Because the documents don't paint a picture of a passive world, right? They describe global forces actively exploiting these Japanese vulnerabilities.
Oh, yeah, absolutely.
Yeah.
So let's look at the first major external shock, energy.
Okay.
Japan is an island nation with very, very few natural resources. They are heavily reliant on fossil fuel imports. So high global oil and gas prices are just devastating to their macroeconomy.
Right, because every time a geopolitical crisis spikes the price of oil, Japan just bleeds cash.
Yep, they hemorrhage it.
They have to sell massive amounts of yen to buy US dollars just to keep the lights on and run their factories.
Exactly. But the documents do show Japan fighting back here. They outline what's called the Seventh Basic Energy Plan.
Right, and this plan is crucial for the future of the currency, isn't it?
It really is. It outlines a strategic pivot involving a massive restart of sidelined nuclear energy facilities.
Oh, wow.
Yeah, alongside a very ambitious push into hydrogen energy infrastructure.
Because if they achieve energy autonomy, they stop that bleeding.
Exactly.
It's essentially a currency defense strategy disguised as an energy policy.
That is a perfect way to put it. But even if they'd solve the energy equation, the research outlines a much more insidious drain on their national wealth.
Okay, what is that?
This revolves around artificial general intelligence, or AGI, and what it creates, which is the digital trade deficit.
Okay, this is where the mechanisms really shift. Like, think back to the 1980s. Japan exported physical Walkmans, televisions, Toyotas.
Right, tangible goods.
Exactly. They shipped hardware out, and billions of dollars flowed in. But today, every time a Japanese corporate worker queries an AI chatbot, or a Japanese logistics company hosts its data on an American cloud server.
A fraction of a yen is microtransacted out of Tokyo and sent to Seattle or Silicon Valley.
Yes. They've gone from exporting physical hardware to basically renting foreign software. And rent is due every single month.
Every single month. And that is the essence of the digital trade deficit. The analysis frames the global AGI race not just as a technological initiative, right?
Right.
It frames it as an arms race for economic supremacy between the United States and China. Both of those powers are pushing AGI as core national policy.
And Japan is just caught in the middle.
Exactly. Japan is severely reliant on U.S. cloud infrastructure and generative AI.
Which completely erodes their historical tech moat. Like, if you are perpetually paying subscription fees to foreign tech monopolies to run your economy, your currency is fundamentally leaking.
It's constantly leaking. And this directly ties into that geopolitical framing we mentioned earlier.
Right, the wealth extraction concept.
Yes. The research provides a really stark analysis of what it terms wealth extraction or blood-sucking from the Japanese economy.
Blood sucking, yeah. They use some heavy words.
They do, and they outline 3 specific pathways for this extraction. The digital service fees to U.S. tech oligarchs is one. Another is massive international capital outflows.
Oh, because the domestic market is aging and stagnant, right. So Japanese corporations and wealthy individuals are pulling their capital out of Japan to find better returns abroad.
Exactly. The wealth generated inside the country isn't staying there to build the future of the country.
Man, that hurts.
It does. And the most aggressive pathway outlined is the harvesting of wealth through U.S.-Japan interest rate spreads.
Okay.
This is known as the carry trade.
Walk us through the mechanics of that carry trade. Why does an interest rate spread siphon wealth?
Okay, so imagine you manage a multi-billion-dollar hedge fund, right?
Right, I'm a billionaire. I like it.
Nice. So the Bank of Japan is trapped, keeping interest rates at basically 0%, like we discussed.
Because of the debt.
Right. Meanwhile, the U.S. Federal Reserve has rates at around 5%. So you can borrow 1 billion yen for almost nothing.
Okay, free money.
You instantly sell that yen, convert it to U.S. dollars, and buy U.S. Treasury bonds paying 5%.
Oh, wow.
Yeah. You are pocketing that 5% spread with virtually no effort.
Just moving numbers around on a screen.
Exactly. But when global investors do this with hundreds of billions of dollars, the constant, massive selling of the yen crushes its overall value.
It just drives the price right down.
Yep. It effectively transfers purchasing power away from the Japanese public and hands it to dollar holders.
That makes total sense. But wait, why doesn't that just self-correct over time? Like, surely markets balance out.
Well, because of the stickiness of the trade. Unwinding hundreds of billions of dollars from these carry trades is incredibly dangerous for global markets.
Like it would crash things.
Yeah, it can cause massive liquidity crunches. So the trade just persists, acting like a permanent gravitational pull downward on the yen.
Wow.
And if we look at the bigger picture, while Japan still exports high-quality physical technology, like precision machinery, to maintain a trade balance on paper.
Right, the official numbers.
Right, but the digital deficit and these capital outflows leak that capital right out the back door.
Okay, so we've mapped the battlefield here. We see the internal constraints, right?
Yeah.
The balance sheet trauma and the aging hourglass. And we see the external abstraction. We've got the energy vulnerability, the digital deficit, and the carry trade.
The blood-sucking.
Right. Let's project this forward. The core mission was to evaluate the 5, 10, and 15-year horizon for the yen.
So to do that accurately based on the sources, we have to factor in de-globalization,
Okay.
the era of frictionless free trade that built Japan's whole economic miracle. That is ending.
So how does a fracturing global supply chain hit them?
It forces a complete reevaluation of their geoeconomic strategy. Look, they built their wealth by importing cheap raw materials from anywhere and exporting finished goods everywhere.
Just a massive global hub.
Right. De-globalization disrupts that supply chain outsourcing. It likely forces Japan into expensive onshoring of production, or it forces them to build much tighter, highly secure supply blocks with specific allies.
Got it. Well, let's put this on a timeline. What does the research actually say about the next 5 years for the yen?
Over the 5-year horizon, expect extreme volatility, specifically against the US dollar.
Okay.
As long as the US maintains relatively higher interest rates, that stickiness of the carry trade we just discussed will continue to dictate the yen's valuation, just keeping it suppressed.
Okay, but what about against the Chinese yuan? Because the whole region is shifting right now.
Yeah, the dynamic with the yuan is very different. China faces its own severe demographic headwinds, but their approach is this massive state-directed push into independent AGI and green energy infrastructure.
Right, they're trying to build their own moat.
Exactly. So in that 5 to 10-year window, we might see regional trade within Asia begin to decouple from the US dollar system due to this deglobalization.
Oh, interesting.
Yeah, the yen may see relative volatility against the yuan as those Asian supply chains reorganize and regional alliances shift around.
Okay, so moving into the 10 to 15-year timeline, this is where the demographic reality really starts to bite, isn't it?
Yes, in 15 years, the success or failure of Japan's internal defenses, the super city clusters and the national automation drive, that will be undeniable. We'll know if it worked. However, the documents project that the digital trade deficit will have solidified into a permanent structural reality by then.
Wow.
Yeah. Without a massive sovereign breakthrough, their reliance on US or potentially Chinese AI infrastructure implies a fundamentally changed, permanently devalued baseline for the yen compared to its 20th century strength.
Which brings us to the harsh reality for anyone listening to this and, looking at their own portfolio.
Right.
The documents pose a really direct question. Is it actually cost-effective to invest in Japan? Because right now, the financial press is just buzzing about Japanese corporate governance reform.
Oh, yeah, it's all over the news.
Right. Companies are finally unwinding those post-crash habits. They're becoming more shareholder-friendly. They're buying back stock. They're actually paying dividends.
And look, those internal reforms are real. Domestic profit margins in certain sectors are absolutely improving. But the analysis forces us to contrast those internal gains against the friction of cross-border investment.
Right, because for you as a foreign investor, the exchange rate can just wipe out your gains. Exactly. Like if a Japanese stock goes up 10% because of great governance reforms, but the yen drops 15% against your home currency over that same year, you've still lost money.
You're in the red.
Right. The text asks, is it actually a good idea to use strong currencies to invest directly in Japanese business assets given these long-term devaluation pressures?
And the overarching advice from the framework is extreme caution.
Interesting.
While the Nikkei might hit record highs in yen terms, the cross-border investor faces massive structural headwinds trying to protect and grow their wealth in dollar or yuan terms.
The currency just eats the profit.
Yeah, the capital cost losses in currency exchange just brutal.
But, and this is wild, the research introduces a concept here that completely flips the script on how to take advantage of this.
Oh, yeah.
They call it dimensionality reduction consumption.
Which is a very, very dense academic term. It basically means purchasing power parity arbitrage.
Right, and I like to translate that into a financial time machine or a geographical cheat code.
I love that.
Because the yen is structurally weak, if you earn your income in a strong currency like the US dollar, the euro, or the Australian dollar, and you take it to Japan, you experience incredible luxury for pennies.
Yeah, the Japanese macroeconomy is essentially absorbing the shock of the devaluation for you.
Exactly. The local citizens feel the pain of imported inflation when they buy groceries, but the foreign tourist or like the remote digital nomad earning in dollars, they live like royalty.
Right.
They are engaging in dimensionality reduction consumption.
It highlights a stark, almost painful divergence in the global economy.
It really does.
The very mechanisms extracting wealth at the national level, the tech deficits, the carry trades, they create an environment where individual foreign consumers with strong currency can extract massive value on the ground.
Okay, let's pull all these threads together. We set out to map the Japanese yen's 5, 10, and 15-year destiny based on these research documents.
Right.
And what we found is that it isn't just a simple story of a central bank pulling levers. It is an incredibly complex, slow-motion tug of war.
Very slow motion. So on one side, you have Japan's internal defense mechanisms. They are desperately trying to offset a shrinking population with automation and super cities.
Yeah.
They're trying to fix corporate stagnation with governance reforms. and they were trying to stop the bleeding of their currency reserves through the seventh basic energy plan, pushing hard for nuclear restarts to ditch expensive foreign oil.
But then, pulling relentlessly on the other side of that rope are these massive external pressures.
Exactly.
You have the US and China sprinting ahead in an AGI arms race that threatens to turn Japan into, well, a perpetual digital tenant.
Just paying rent forever.
Right.
Okay.
You have the reality of digital trade deficits siphoning capital outward every single month, and you have the sticky global carry trades constantly exploiting the interest rate gaps caused by Japan's domestic debt trap.
The structural forces leaning against the yen are profound, and while a 15-year outlook is never written in stone, the blueprint provided by this analysis suggests that without a miraculous leap in sovereign technological innovation,
Which is a big ask.
it's a huge ask. Without that, the long-term path points toward managed structural devaluation.
So we started by comparing the Japanese economy to an hourglass. The sand is flowing out, the demographics are shifting, and the rules of global trade are fundamentally reorganizing.
Right.
We've seen how internal debts and an aging population create vulnerabilities, but we've also seen how the real battleground for national wealth has shifted, right? Away from manufacturing physical goods and into the cloud and artificial intelligence.
It's a totally new era.
Which brings us to the final thought we want to leave you with today. Something to mull over as you look at your own investments or your own country's tech sector.
Yeah, this is the big takeaway.
If the ultimate wealth of a nation in the 21st century is determined by its sovereign control over its own artificial intelligence and digital infrastructure, can a country with an aging population and a depreciating currency ever truly buy its way back into the technological arms race?
It's a tough question.
Or are we witnessing a permanent shift in what it actually means for a developed nation to be wealthy? Think about that hourglass. Until next time, keep diving deep.